Over the last few days, Grab stock is a company that's got a lot of attention by both retail as well as Wall Street, and we can already see a triple buy rating. In fact, Quant with the strong buy, Wall Street themselves not far off the 4.5 to turn this into a buy. So should we be looking at this as an undervalued play? Is this one we should consider adding to our growth portfolio? We're going to find out all the details today. Firstly, this is a company up 53% just over the last 12 months, and as we can see, in fact, looking very strong in the pre-market, up nearly 12%. Now we're going to start off with a quick background about the company for those that don't know. They are essentially a Southeast Asian technology company that offers ride-hailing, food delivery, package delivery, digital payments, as well as financial services, and they started as a taxi booking app in Malaysia in 2012 and later expanded into the multiple services, becoming a super app in countries like Singapore, Indonesia, Vietnam, Thailand, and the Philippines. Now, as you can see, quite a lot of different services. We have Grab Ride, Grab Food, Grab Express, which do cover a wide range of different income streams, and they've ultimately grown into a dominant player in the Southeast Asian market. Now, we also want to bring to your attention that this company is reporting their earnings over the next few days, and if we take a look at how they've been over the last 4 quarters, we can see they have beaten or at least been in line 3 of the last 4 quarters, giving them a 75% track record. Even the one they did miss was very marginal by 1 cent, and the next quarter that they are due to report very soon, they're anticipating 96% increase to the EPS on a year-on-year comparative. Now, their 2024, as we can see, EPS was negative. However, the expectation for the next full year of December 2025, 4 cents, does mean this company is already trading at a ridiculously high forward P, sitting around the 113 mark. If we were to look at their valuation grade, no surprises then why you do get a D+, but if we just look at the sector comparative, with Grab, as we saw, over 100, right now the sector sitting around 20, so you are paying a massive premium, but it doesn't just stop there. If you do want to look at other valuation metrics, EV to sales, EV to EBITDA, price to sales, even the price to book, all showing quite a large premium for this company. But don't let that put you off. Sometimes premiums are demanded for companies that we do believe to look very strong in the growth department as well as profitability. That is what we want to understand today, where they do get an A+, growth specific, year-on-year revenue up 22% above the sector at 4%, forward looking at 33% expected above the sector comparative of 5%, and we can see year-on-year their free cash flow is up 571%, a lot higher than the sector comparative at 9.2, as well as their operating cash flow 551 above the 5.33. If we look at the profitability aspect, they get an A. Gross margin looking strong at 42%, significantly above the sector at 32%, significantly above their own 5-year average of 2.74. But one thing we don't quite like to see is over the last 12 months, they did in fact lose money. Net income margin -4%, the sector at 6.5%. Good to see their cash from operations 573 million, with the sector comparative at 350 million, and also higher than their own 5-year average, where we can note they were burning through cash -319. We do also want a very quick run through from their latest quarterly earnings. Their revenue was up 17% on a year-on-year comparative, and their gross merchandise value also up around 15%. Now, looking specifically to the different segments, we start off with the deliveries, which was up around 13% year on year. Also good to see the EBITDA up 60%, and this is also reflected in the other segments. For example, mobility, we see 17% positive, as well as the EBITDA up 18%. And finally, we get to the financial services element, a bit of a faster grower than the other two, up 34%, although we do notice that EBITDA for this portion is negative, but actually moving in the right direction on a quarter-on-quarter comparison. In terms of what they expect for this full year, remember they are reporting for that latest quarter. They expect revenue growth to show 17 to 18%, which was actually higher than what they had previously guided for 14 to 17, and the same goes for the EBITDA, and higher expectation of over 300 million. Prior to that, they thought 250 to 270, and they've kept their 2014 adjusted free cash flow positive for the full year, something we'll discuss when we get to our own discounted cash flow model. In terms of the underlying metrics, well, free cash flow, we always want to see here consistent growth over the longer term, but what we really like is the fact it has gone negative to positive pretty much on a very consistent basis over the last few years, based on a trailing 12 month positive 12 cents, and the expectation is over the next 12 months for this figure to get higher. And remember, this is where we can see some good opportunities for companies where they have been negative free cash flow, where their numbers have been lacking historically but have started to improve on a quarter by quarter, year on year basis, and that is something again we want to understand purely down to the valuation later. In terms of sales growth, well, we do get double digit over the last full year. As we saw for 2024, they are expecting around 17 to 18%. So maybe there is also a question of whether or not the growth that we are seeing with this company, especially on the top line, does match the very high valuation we did see earlier on. But from a numerical basis, over the last few years, this company has gone from reporting 470 million in 2020 to now sitting at 2.36 billion. We always have to flag shares outstanding because ideally we want companies that return excess cash to investor pockets through those share buybacks. What Grab has done is actually dilute your position over the last few years. Now, typically this isn't what we want to see, but bear in mind, if a company can massively outperform the S&P, it probably isn't a major worry. In terms of the ROIC, typically want 10% or more to give us faith management are able to effectively allocate their capital. As we can see, they haven't really had any years of positive bottom line, thereby negative. We'll show that again through the income statement shortly, but that's also reflected on the operating margin where it is consistently negative, but has been improving, getting smaller and smaller. Hopefully over the next year we can see a positive operating margin, and the free cash flow margin, something similar to what we saw on the free cash flow per share. Nice to see that on a trailing 12 month, we are seeing a very good number here of around 18%, as typically we want a minimum of 5%. Finally, the net debt to EBITDA gives us some strength about the balance sheet. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Over the last 12 months, 0. Over the next 12 months, 0 again expected, which means this company won't even take them one day to pay off all of their debt net of cash on hand, something we'll also show you through the balance sheet review. In terms of what the institutions are doing, well, they are very, very bullish. 55% overall ownership, around 1 billion worth of sales over the last year. They've been buying a significant amount more, 6.33 billion in all of 2024. But the large bulk of this has in fact come from the latest quarter where they bought around 5.4 billion. So clearly, especially in the more recent term, institutions have become very, very bullish on this company. If we then just quickly look at the performance against others in this industry, as we can see some very large and well-known names. In terms of the return over the last year, Grab is up around 44%. It is one of the best, as we can see. In fact, quite a large portion of these competitors have returned negative. As always though, past performance is not reflective of the future. As we already highlighted, in terms of their top line revenue, it has been looking strong over the last few years, increasing fairly consistently. Some years a lot stronger than others, but still in the double-digit region. What we really want to identify and point out today is their bottom line net income, which, as we mentioned, was negative. In fact, that is clearly shown here, but it is getting smaller and smaller, and hopefully in 2024 or in fact 2025 we can see this company start to turn a positive bottom line, essentially a net income as opposed to a net loss. Then we do a quick health check of the company, total cash versus total debt. Now we can in fact see their cash position, whilst inconsistent, has increased over the period. 2019, 2.8 billion, now from that latest quarter sitting at 5.8, and we also always compare it to their total debt numerically and directionally, because one number here in isolation isn't going to tell us anything. And then when we get to their total debt, we can actually see it has decreased quite significantly, in fact going from 8.6 billion in 2019 to now 328 million. So their cash significantly superior. As we highlighted earlier, it won't even take this company one day to pay off all of their debt net of cash on hand. In terms of the cash flow, we just want to pinpoint here the cash this company does generate from operations, as it has been negative over the last few years quite consistently, but in the most recent year, 2023, it is 86 million, and on a trailing 12 month, this company generates 573 million, something we do anticipate to only get larger from here on out. Now, before we jump into the valuation, we want to let you know we have just released our latest free weekly article. We drop one every single Monday morning to your inbox, completely free, where we highlight significantly undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll also be able to gain a copy of 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and read straight away. Then we get to our intrinsic value, which today comes to $6.18, in fact derived from the DCF model. Now we'll show you how we got there. We have the free cash flow over the last few years. Average growth is negative. In fact, the vast majority have been negative free cash flow on a year-on-year basis. Now we have a low, medium and high, 25, 30, 35. As always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it is for grab or any others. But based on 30% growth rate with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see today, $6.18, which translates to 12% upside. Now, full transparency, for those that believe 25% should be the growth rate, it's actually telling us right now this is worth around $5, which means it is overvalued at the current point, and in fact what's baked into the growth rate is around the 25% mark. For those that are a lot more bullish, believe that these numbers are way too low, we can in fact see 35% would indicate $7.75, giving this 40% upside. Now we're not done there, as we always like to add a margin of safety as an element before considering buying or selling, and typically we use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If we believe that in today's episode, we can in fact see at this price right now in the pre-market, you're getting the 10%. For those that want 15%, you'd have to wait for $5.25. At 20%, just under $5, and at 25, $4.63. As we said though, only 10% MOS, and even Wall Street with their buy rating, they see this company at $5.70 over the next 12 months, which really only translates to 3% upside. As we said though, these figures are based on these growth rates. In fact, we have gone for the 30%, so if you believe it should be higher or lower, this will skew the margin of safety one way or another. But give us your thoughts. Do you believe grab stock is a buy, maybe a hold, or in fact now is a great time to sell? Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. We have been buying and selling given the volatility over the last few weeks, and as always, have a great day. We'll see you all on the next one.